Silver hasn't expressed that yet. If it were to simply express a price equivalent to $50 back in 1980, I haven't done the math, but I'm sure it's 200 or higher. So, you can make that case, sort of a broad fundamental. But what I'm arguing is it's likely to do it very rapidly, not incrementally. And that's the key right now, I think, is now. Don't think out 2-3 years. Think of what could likely happen in the next couple quarters. Gold breaking out versus the S&P is a statement. It's saying somebody's moving big money.
In this sharp market analysis, momentum strategist Michaeloliver highlights why silver may be on the edge of a rapid and dramatic price shift. Rather than focusing on slow, incremental gains, the current setup suggests silver could move violently higher in just a few quarters. According to the analysis, silver has not yet expressed the kind of price behavior seen during previous major peaks. If the metal were simply to match its inflation-adjusted equivalent of $50 from 1980, the fair value target would already be well above $200. But the argument goes beyond fundamentals. The expectation is that silver's next major move will unfold fast, not gradually, triggered by a sudden shift in sentiment and institutional flows. At the same time, gold has already begun sending a powerful signal. Its breakout relative to the S&P 500 marks a major rotation of big capital into hard assets, and this trend is only in its early stages. If gold is leading, silver historically follows with even more intensity. With momentum building beneath the surface, the coming quarters may redefine the entire precious metals landscape. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
Silver versus gold spread chart also, where you don't look at the price of silver, you don't look at the price of gold. Instead, what you do is you divide the futures contract December silver right now into the price of December gold, and you express the answer of that as a percent. You'll see that we've developed a spread chart basing action, much like that gold versus S&P basing action, where silver's had a surge back in 2020. You recall that move where silver went from like $15 to 30 and gold only went up about 40%. Well, silver outperformed up through late 2020. And then we went into that multi-year period where, gold went sideways through early 2024. And silver and the miners actually sort of declined in relative performance. No, they were going up. There was a rise, net rise there, but they were underperforming gold, the mama metal. Silver has been surging versus gold since early this year, about April. It's really come up sharply on a relative basis, so it's been a better place to be, net on balance for the year. But you're challenging now a massive spread breakout base, where not only is gold saying, I'm going to break out versus the stock market, silver saying, I'm going to break out versus gold on a relative place to be. And so if the monetary metals are now moving into a fresh, massive asset class shift versus the S&P, the U.S. stock market, silver is also saying the same thing, except I'm no longer going to be the little dog that follows behind gold. I'm going to outpace gold. So if you're going to shift to monetary metals now, and if you're not in these markets, for example, a lot of people aren't, I'm suggesting, MSA is arguing that the metrics that we're talking about here are saying something big is about to begin in terms of asset class shift, favoring monetary metals, but especially silver. And it's starting now. There is a relationship between gold and the S&P 500 or the U.S. stock market bubble, and you can plot it. It's called a spread relationship. We simply divide the front month of active contract of gold futures into the price of the S&P and express that as a percent, and we plot it, okay? Every end of every month, we plot one little dot, okay? When you plot that chart, we've shown it in prior reports, you've got a 11-year wide base on that chart, where gold back in 2011 was at a higher relative level to the S&P. And during its bear market, 2011 through, especially 2013 through 15, gold dropped, but also its relative performance dropped to the S&P. But then actually since 2014-15, you could basically take that same spread chart, draw a line sideways, and gold's been above and below and above and below. It's really been par to the S&P. Depends on when you bought gold relative to the S&P, you're doing better. Now, especially since 2024, that spread has moved up sharply. Now, When you look at the spread chart, there is a massive, very clear line across every single rally high that relative performance surges have created. So you could take a crayon and have a 5-year-old draw the line for you. Unfortunately, most people don't plot the spread chart. And if you did, you would see that this month's close, we have a half a day trading left, I think on Friday, is out above that base. Meaning that while gold has handily beat the S&P, especially since 2024, coming up from the lower end of that base, it's now punched out above it. So if you were just looking at that chart and I erased the words gold versus S&P and didn't tell you what it was, and you thought, well, that's a price chart of some stock, you'd say, I got to buy that thing, okay? Because you break it out of a base that an idiot could see. But everybody thinks that gold has gone too far, it's got to correct, or it's excessive. And that's because they're focused on what? A simplistic price chart. And when you run a relative performance chart, it's saying not only has money been moving into gold since 2024 soundly, solidly, it's now breaking out. Meaning that the money flow that we've seen coming out of doubters in the stock market, some large skeptical asset managers, let's assume, who've said, hey, I need a little bit more in that monetary metal sector.
In this detailed market breakdown, momentum analyst Michael reveals why silver may be on the verge of a major outperforming cycle, not just against gold, but against the broader stock market. By focusing on spread charts rather than raw price action, a clearer picture emerges of a deep structural shift already underway. Instead of simply tracking the price of gold or silver, the spread analysis divides the active silver futures contract by gold futures and expresses it as a percentage. This creates a powerful relative performance chart, and that chart is now signaling a massive breakout. Silver began outperforming gold sharply in early 2024, reversing several years of underperformance. That move has now brought silver to the edge of breaking above a long-term basing formation, one that mirrors gold's breakout versus the S&P 500. This shift is crucial. Gold has already moved decisively higher relative to the U.S. stock market, completing an 11-year base and pushing into a new structural trend. Silver is now preparing to follow, but with even greater strength. The message from the spreads is clear. Capital is beginning to rotate away from the stock market and into monetary metals. And this time, silver doesn't appear ready to lag. It looks ready to lead. The metrics suggest a major asset class reallocation is beginning right now. Let's get into the interview.
Well, silver has been a monetary metal as well, including in the U.S. at times, okay? So it's not the only monetary metal. There's other governments out there that are even looking at silver in that regard. But it will go up with gold. But the main point I'm making right now is it's just on the industrial side of silver, which it has, which gold doesn't have. The supply demand for silver has been excess demand every year for like 5 years now. Supply can't meet the demand. And the demand is high tech. There's all this AI talk we have. Silver's involved in all of that in micro basis, but massive quantities. And it's also involved in solar. And solar is quite important in many parts of the world now where you don't have public utilities and so forth, that you're in Africa somewhere, or you're remote parts of Asia, and the Chinese are satisfying that demand by creating solar cells and solar panels with silver is essential in the silver cell process. And it's those two factors alone are just dwarfing the new supply of silver. And one of the problems with the supply of silver is that it doesn't come from silver mines. Yeah, so about a third of it does, as I understand, but most of it comes from base metal mining. And so the company that produces a lot of silver might not be primarily focused on whether the price of silver is up to increase their production of, let's say, magnesium or copper or something. It's not motivating them to increase production. Why? Because it's marginal in their overall operation. So that's sort of a unique situation for silver supply-demand issue. But as far as monetary metals, it has always been one. Don't forget that. And I do think that at the end of, not necessarily in the first 6 months, but a lot of that could reveal other factors out there as well, which I think will become exposed, that suddenly people start pulling their hair out saying, gee, I didn't expect that. Gee, I didn't expect that. One of the factors that we noted months ago, MSA did, is that Bitcoin was going to crash. And we got laughed at, of course, naturally. And the feverish investors in that market, a lot of them are young. Unfortunately, a lot of them are large corporations now, have gotten hip deep in the crypto market. It crashed. We went from 127,000 to 82,000 in a matter of 1 month to another month's low. Okay, that you call a crash. And I don't think it's over. You're having a bounce right now, but I think it's BS. I think ultimately you could see Bitcoin, which is like 57% of the crypto market, down in the 60,000 area in the next wave of decline.
In this eye-opening analysis, market technician Michael Oliver highlights a critical but often overlooked force behind silver's next major move: real-world supply pressure. While silver has always held a role as a monetary metal, its industrial demand has now surged far beyond what global production can reliably support. For 5 consecutive years, silver has faced a persistent supply deficit, an imbalance driven by rapid growth in high-tech applications, AI hardware, and solar energy infrastructure across developing regions. What makes silver especially unique is that most of its supply doesn't come from primary silver mines. Instead, it's produced as a byproduct of base metal mining. That means rising silver prices don't automatically increase production, because miners are focused on their main metals: copper, zinc, nickel, not silver. This structural constraint creates the foundation for extreme upside once investor demand accelerates alongside industrial consumption. Adding to the mix is growing financial instability. Bitcoin's violent crash, which Oliver's models predicted months earlier, is now reinforcing a broader shift toward hard assets. With silver carrying both monetary credibility and industrial necessity, it is positioned to outperform dramatically when the next wave of capital rotation begins. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in.